Interest-only repayments on an owner-occupier loan cost more. 1 in 4 owner-occupiers in Australia are failing to chip into their loans by making interest-only repayments. David Koch explains how choosing the right mortgage can save you lots. 1 in 4 owner-occupiers in Australia are failing to chip into their loans by making interest-only repayments. Reserve Bank of Australia figures showed in the latest biannual financial stability review about 24% of borrowers living in their own home are not paying down their debt. Many parents are worried their children will never be able to afford a home. This has remained relatively steady since about 2014 despite rates now resting at record lows, many are below 4%. Australian Bankers Association's chief executive Stephen Munchenberg said it was important borrowers had a plan to pay off their mortgage by making both principal and interest repayments. While they have an outstanding debt, they are paying interest on that, and the longer you take to repay your loan, the longer in total interest that you bump up your loan, he said. The borrower might decide earlier on they are going for a period of interest only before going to principal and interest. This can be the case if they are starting a family, and it can be a good way to get through this process. But Mr. Munchenberg said, when borrowers apply for a loan, they are assessed on whether they can afford principal and interest repayments. Usually the standard historical interest rate of 7% applies to the repayments as a gauge to working out whether borrowers can cope with rate hikes. But Tribeca Financial's chief executive officer, Ryan Watson, said as a general rule of thumb, interest-only repayments remained a bad idea for owner-occupiers. Generally it means people have overextended themselves and they are relying on the value of the property to increase in order for them to create equity in their home, so it does stretch people, he said. My concern is if interest rates, like they inevitably will do, rise over the next 2, 3, or 4 years, then people might be left unable to afford those interest-only repayments, which can have a dramatic effect. Sometimes lenders will also charge borrowers a higher interest rate if they are on interest-only repayments. At Sophie Eelsworth,